When we talk about China's economic downfall, what has gone wrong? So in today's video, we're going to break it down from top to bottom to help you understand all these factors. Keep watching till the end to know all about it. Firstly, zero COVID is wreaking havoc. COVID outbreaks in several cities, including manufacturing hubs like Shenzhen and Tianjin, have harmed economic activity in various industries. People are also not spending money on food and beverages, retail, or tourism, which puts a strain on major services. On the other hand, according to the National Bureau of Statistics, factory activity appears to have increased again in September. The rebound could be due to increased government spending on infrastructure. However, it came after 2 months of no growth in manufacturing, and it has raised concerns, particularly since a private survey revealed that factory activity fell in September, with demand affecting output, new orders, and employment. Higher interest rates, inflation, and the war in Ukraine have all reduced demand in countries such as the United States. Zero COVID poses a threat to China's Xi Jinping. Experts agree that Beijing could do more to stimulate the economy, but there is the only reason to do so once the zero COVID period expires. It's pointless to pump money into our economy if businesses can't expand or people can't spend it, said Luis Cugis, chief Asia economist at S&P Global Ratings. Secondly, China's property market is in a crisis. Weak real estate activity and a general lack of confidence in the housing market have undoubtedly slowed growth. This has had a significant impact on the economy, as property and other industries contribute to its account for up to a third of China's GDP. Homebuyers have refused to make mortgage payments on unfinished buildings, and some are skeptical that their homes will ever be finished. As a result, demand for new homes is declining, reducing the need for imports of construction materials. With property developers under pressure, analysts believe the government will need to do much more to restore confidence in the real estate market. Thirdly, Beijing isn't doing enough. Beijing has announced a 1 trillion yuan plan to boost small businesses, infrastructure, and real estate in August. However, officials can do a lot more. This includes increased infrastructure investment, easing borrowing conditions for homebuyers, property developers, local governments, and individual tax breaks. Next, investors are fleeing China's tech titans. A 2-year-long regulatory crackdown on China's tech titans isn't helping matters. Tencent and Alibaba both reported revenue drops in the most recent quarter, with Tencent's profits falling by 50% and Alibaba's net income falling by half. Also, climate change is exacerbating the situation. Extreme weather is having a long-term impact on China's industries. For example, in August, a severe heat wave was followed by a drought in the southwestern province of Sichuan and the central belt city of Chongqing. As air conditioning demand increased, it overloaded the electricity grid in a region that is almost entirely dependent on hydropower. As a result, factories, including major manufacturers such as Apple's Foxconn and Tesla, were forced to cut hours or close entirely. According to China's Statistics Bureau, profits in the iron and steel industry fell by more than 80% in the first 7 months of 2022, compared to the same period last year. Beijing eventually invested tens of billions of dollars to help energy companies and farmers. If that's not it, the growth is being hampered. Tens of thousands of young workers have lost their jobs, contributing to a jobs crisis in which 1 in every 5 people aged 16 to 24 is unemployed. In the long run, this could harm China's productivity and growth. Investors are also noticing a shift in Beijing, with some of the country's most successful private companies coming under increased scrutiny as Mr. Xi's grip on power tightens. As a result, foreign investors are withdrawing money from state-owned enterprises, which appear to be gaining favor. SoftBank of Japan withdrew a large sum of money from Alibaba, while Warren Buffett's Berkshire Hathaway is selling its stake in electric vehicle maker BYD. Tencent has withdrawn more than $7 billion in investments in the second half of this year alone. Furthermore, the U.S. is cracking down on Chinese companies listed on the American Stock Exchange. The world has grown accustomed to the fact that Beijing may not be as open for business as it once was, but Mr. Xi has been jeopardizing China's economic success in recent decades. China's economy expanded at the slowest rate since the COVID-19 pandemic began in the second quarter. Between April and June, its economy grew by only 0.4% year-on-year. Low consumer spending. Lockouts across the country have stifled industrial production, causing it to fall short of market expectations and resulting in lower consumer spending. China's non-manufacturing PMI which measures growth in the construction and services sectors, fell to 53.8 from 54.7 the previous month, indicating slower growth in those sectors of the economy. China is losing its competitive advantage. 60% of companies and 82% of manufacturers now report that production has slowed during the current outbreak due to a lack of employees, inability to obtain supplies, or explicit factory halts due to the lockdowns. The impact of the Russia-Ukraine conflict. Because China is an export-driven economy, supply chain disruptions caused by the Russia-Ukraine conflict have exacerbated its difficulties. Some economists are debating the possibility of a balance sheet recession in light of the turmoil in Chinese markets. The immediate impact on the Chinese economy is likely to be much less severe, at least in the short run, but still negative. The sharp increase in energy prices is bad news for China, given its reliance on imports, and that China's carbon reduction goals, as outlined in its 5-year plan, necessitate additional gas imports to transition from coal. Indeed, one key outcome of the China Two Sessions, meetings of the National People's Congress and the Chinese People's Political Consultative Conference in early March 2022, was a temporary freeze on annual carbon emission targets to deal with the war-fueled rise in energy prices. The slew of Western sanctions imposed on Russia is another immediate drag on the Chinese economy. As a result, Chinese corporations and financial institutions will have to tread carefully when trading with or investing in Russia, and this appears to be happening already. Chinese banks are no longer issuing letters of credit for trade with Russia, and Chinese energy companies, including Sinopec, are deferring projects with Russian counterparts. Nonetheless, the impact of such Russian retrenchment should be relatively minor for China, given that Russia is 10 times smaller. Furthermore, China does not need to cut ties with Russia. It only needs to avoid hard currency payments and certain targeted entities, such as the Russian Central Bank and the Ministry of Finance. So how is it impacting the global economy? According to a recent update of the World Economic Outlook, economic prospects have deteriorated significantly in recent months. As a result, the IMF revised its global growth forecasts from April, predicting that output will fall to 3.2% in 2022, down from 6.1% last year. Inflation is also rising faster and more broadly than the IMF predicted earlier this year. It now forecasts a 6.6% increase in rich countries and a 9.5% increase in emerging markets and developing economies. Growth is expected to slow down even further next year as central banks around the world raise interest rates in an effort to cool their economies and tame inflation. The likelihood of a global recession is increasing, according to the report. It stated that the likelihood of a recession starting in one of the group of 7 advanced economies was now nearly 15%, nearly 4 times its normal level. Companies taking a hit. Companies such as Apple have warned that COVID-related supply disruptions could cost them up to $8 billion in earnings. General Electric reports that lockdowns are suppressing demand as well as causing the supply chain problem. In the long run, the falling of the Chinese economy into systemic risks could lead to the overall decline of acceleration in the global economy. That's it for today. Do you think this global recession will affect other parts of the world? Let us know your views in the comments below, and we'll be back with another interesting video soon, so stay tuned.